One of the questions that new and even experienced investors struggle with is how many stocks you should own. Hey guys, it's Jeffrey. Welcome to my channel. In my channel, I want to give a true financial education. I don't want to just talk about individual stocks and individual side hustles. I will talk about those things, but I think it's important to step back once in a while and just talk about general investing. So in this video, we're going to talk about a subject that most investors struggle with, which is asset allocation. We're going to talk about asset allocation as it relates to individual stocks. We're going to touch upon how many stocks you should own. We're going to talk about how much you should put into each stock. This video is not going to be simple, so if you are driving or just listening, make sure to maybe wait until you get home and watch it in front of your computer screen. We're going to go over spreadsheets. We're going to go over math equations. I'm going to try to communicate as simply as I can, but make sure to pay close attention so you can thoroughly absorb the content. First off, I just have to say that I'm no expert when it comes to stock market investing. I feel like I say that in every video, but I'm just an individual investor that has thought deeply about this subject. If you follow this channel, you know that I own Tesla stock. I actually started buying Tesla stock about 5 years ago, and since then, the stock has more than 15x. I'm not saying this to brag or anything, quite the opposite actually. I actually feel like I've lost a lot of money in the stock market because of all the money that I should have made. Even though back then I believed Tesla to be extremely undervalued and my conviction was very high, I failed to concentrate my portfolio into Tesla. And after this experience, it caused me to think more deeply about asset allocation. Asset allocation is just a means to an end. The end goal of investing is pretty simple. It's to make as much money as possible while taking the least amount of risk. So when thinking about how much to invest in a company, you should be thinking about two things. Number one is, what is the potential return? So how much would you make if you're right? Number two is your certainty. So how confident are you that you are correct? Or in other words, what is the risk that you were wrong? Of course, there is no such thing as an opportunity that has a 100% certainty. Even the greatest opportunities have risks that is beyond anyone's control. That's why you would never put 100% your net worth into any one investment. And that's why you need to spread your bets. But every investment has a theoretical return and a theoretical risk level. It's your job as an investor to figure out what that return is and what that risk is. Only after you determine the risk level and the potential return level can you make a decision about how much to invest. So to answer the question about how much you should invest into any individual stock, the answer is it depends. It depends on the return and it depends on the risk. When you have an understanding of the risk level and the reward level, you can use a well-known formula called the Kelly Criterion. Named after a scientist named John Kelly, the Kelly Criterion is used by professional gamblers like card counters to determine bet sizes. It's also used by many successful investors, including Warren Buffett. Basically, all you have to do is input the return level and then the probability of getting that return, and the Kelly Criterion will tell you how much of your bankroll or portfolio that you should bet. I'm not going to go into a math class in this video, but I'm just going to put the formula up on the screen. You can pause and take a look at it, or you could just go on Google and Google Kelly Criterion. There's calculators out there, and you can just go and take a look at those. To give some examples of the Kelly Criterion, let's say that there's an investment that has a 60% chance to triple, otherwise it will go to zero. Based on the Kelly bet, which is the bet you should make using the Kelly Criterion, you should bet 40% of your portfolio. To give another example, let's say that there's an investment that has a 50% chance to double, otherwise it'll go to zero. In this case, using the Kelly bet, you should bet 0% of your portfolio. This is because this is a pure gamble, it's a coin flip, and therefore you should bet nothing. The problem with using the Kelly Criterion, besides it feeling too aggressive, is that the Kelly Criterion is not really suited for long-term stock market investing. The Kelly Criterion assumes that there are two outcomes. Either the investment works out and you make a set amount, or the investment doesn't work out and you lose your entire bet. Investing in stocks is not really the same thing. There are multiple outcomes. Either the stock goes up, it can go down, it can double, it can triple, it can stay flat. And usually the stock doesn't go to zero. So in order to apply the Kelly Criterion to long-term stock market investing, I created this table based on the Kelly Criterion. On the top here on row 2, I put what the expected 1-year return for a stock. On the left, on row C, I put the probability of that return occurring. So what the table returns is the Kelly bet, or how much of your portfolio percentage-wise you should bet, which is shown here in either green or red. Green meaning you should bet and how much you should bet, and red meaning you shouldn't bet. This table is still a bit flawed because you really never know the probability of the return rate happening, but what you can do is you can make guesses and assign a probability to your guesses, or a weight to each guess, in order to get a weighted average. After you get a weighted average, then you can assign a confidence level to your estimates. I know that's a lot, so let me show you an example. Here's an example of me doing this for a stock that I own, Airbnb. I made some guesses on what I think the stock could be worth in 2025, which is 4 years from now. I put in those prices on column C, and then I put in the probability of each of those prices occurring on column B. After I put in all those values, the spreadsheet gives me a weighted average of all those prices, which then becomes my price target. Using that price target, I calculate my compounded annual growth rate, or CAGR, which becomes the expected return value that I use for my Kelly bet. Then I put in my confidence level for my estimations, and the spreadsheet gives me the Kelly bet by using the Kelly Criterion formula. In this case, the current price of $183 with a confidence level of 9, the spreadsheet says that I should bet around 11% of my portfolio, so around $34,000. So to see how this works, let's go back to the table. Based on my weighted average calculations, Airbnb had an 11.3% CAGR, so I'll change this top row here to 11.3. After I do that, the table tells me that I should only bet if the probability of getting that 11.3% return is 91% or higher. If you notice here, I correlated the probabilities to confidence level. So the way that I think about it is, how confident am I that my estimations are correct? I'm never going to be 100% correct, so even if I'm a 10 confidence level, I assign a 95% probability of being correct. If I'm a 9 confidence level, then I assign a 91% probability of being correct. So basically the table is telling me that I have to be at least a 9 confidence level in order to invest, and at a 9 confidence level, I should invest 11% of my portfolio. I don't use the spreadsheet and follow it to a T or anything. I just use it to give me a rough idea of how much to allocate to each individual stock. The spreadsheet is also not to be taken as fact. It's just my opinion expressed in spreadsheet form. And additionally, the spreadsheet is very sensitive. You'll see if I play around with it and just tweak the numbers even just a little bit, the Kelly bet changes dramatically. Just small changes to the confidence level or the current stock price makes a really big difference. But I don't think this specific spreadsheet is that important. It's the underlying principles that this spreadsheet communicates that is more important. The spreadsheet basically says that the higher the return and the higher your confidence level, the more you should bet. And I'm not just talking about confidence level in terms of emotional confidence, like I feel like this stock is really good. I'm talking about confidence level that can only be achieved through doing due diligence and through a long period of time. The way that I structure my portfolio now is kind of based on this spreadsheet. Whenever I hear of a company that I'm interested in, I start with a small position, like 1 to 5% of my portfolio. This is when the information about this company that I have is low. I don't have a good idea of the expected return, and I don't have a high confidence level of this return. So that's why my position would be very small. At this point, I'm just really relying on efficient market theory, which basically means that I'm relying that the stock price reflects all the information out there. So I think that the stock should be fairly priced for a moderate return over time. But really, I'm just buying the stock as a way to motivate me to do more research about the stock. If I do the research and I determine that the potential returns are high and I gain a higher confidence level, then I buy more stock. If I do even more research and then I determine that my confidence level is even higher or my return level is even higher, then I buy a lot of stock. Another lesson that I learned with this spreadsheet is how you should theoretically average down your costs when buying stock. A common strategy that people use is to not buy your full position of a stock all at once. So for example, let's say you had $12,000 to buy a stock and you wanted to split up your buys into three. So you can start off by buying $4,000 worth of shares of that stock. And then if that stock comes down in price, you can average down and buy $4,000 more of shares in that stock. And then if the price comes down even more, you can use the rest, the last $4,000 to average down again. This makes logical sense, but in my opinion, it's the wrong approach. Theoretically, you should bet bigger when the stock price is lower, assuming that nothing has changed about your investment thesis. The lower the stock price, the higher your expected return. You should bet some money when your expected return is moderate, but you should bet a lot of money when your expected return is high. So in a perfect world, assuming the same scenario of $12,000 to buy a stock, you start off your position with $1,000. If the stock price comes down, you buy another $3,000. If the stock price comes down even more, you use the rest of your money to finish out your position, which is $8,000. This would ensure that you're putting the majority of your money when the stock price is lowest and your expected return is highest. I wish I created this spreadsheet a long time ago, or at least thought about it more deeply when I first started learning about Tesla. I remember back then in 2017 or so, the stock was trading at $250, which was pre-split, so about $50 today. And I had a prediction that the stock would 4x by the end of 2020. Funny enough, the stock ended up going up more than 14x from that level. So if I had that spreadsheet back then and I put in my predictions even at a 4x level, my conviction was very high, by the way, at the time. The spreadsheet would have told me to put in 75% of my portfolio, which at the time would have equated to about $90,000. So 14x of $90,000 is about $1.3 million. Yep, so I literally feel like I lost $1 million by missing out on this Tesla opportunity. Sure, this is anecdotal and I probably would have traded my position on the way up, but I definitely made the mistake of spreading my bets too thin and not betting heavily enough in Tesla given my expected return and my high conviction. Opportunities like Tesla pre-2020 and also Tesla March 2020, which by the way I also missed. These golden opportunities, they are very rare, but they do happen to us once in a while. I think that these golden opportunities happen to everyone maybe 5 to 10 times in our lifetimes. As a long-term investor, all you have to do is act on 2 or maybe 3 of these opportunities in your lifetime where you have a high confidence level of a very high return. After you do that, you're done. All you have to do is just wait. So I do think that there will be more opportunities. Maybe Tesla will drop significantly from here and Tesla can be that opportunity again, or the opportunity might be in other stocks. Nevertheless, when that opportunity comes, I will be sure to make a proper bet. If you don't have the time or desire to do your own due diligence, then just buy index funds or diversify by buying many stocks. I'm not saying this as a bad thing. You'll get market returns and you'll do great over time. Additionally, even if you do have the time and desire, but you don't see any lucrative opportunities, then it's also okay to buy index funds and diversify while you look for these opportunities. I know that I didn't directly answer the asset allocation questions of how many stocks you should own and how much of each stock you should own. But just like the answer to many questions in life, the answer to these questions is it depends. So I'll close with some quotes from Warren Buffett that aligns with some of the messages from this video.
Big opportunities in life have to be seized. We don't do very many things, but when we get the chance to do something that's right and big, we've got to do it. And even to do it in a small scale is just as big a mistake almost as not doing it at all. I mean, you've really got to grab them when they come. And because you're not going to get 500 great opportunities. You would be better off if when you got out of school here, you got a punch card with 20 punches on it. And every financial decision you made, you used up a punch. You'd get very rich because you'd think through very hard each one. I mean, you went to a cocktail party and somebody talked about a company you didn't even understand what they did or couldn't pronounce the name, but they made some money last week and another one like it. You wouldn't buy it if you only had 20 punches on that card. There's a temptation to dabble, particularly during bull markets. In stocks, it's so easy. It's easier now than ever because you can do it online. Just you click it in and maybe it goes up a point and you get excited about that and you buy another one the next day and so on. You can't make any money over time doing that. But if you had a punch card with only 20 punches, you weren't going to get another one in the rest of your life. You would think a long time before every investment decision, and you would make good ones and you'd make big ones. And you probably wouldn't even use all 20 punches in your lifetime, but you wouldn't need to. Yep.